There's been an increase recently in new litigation filed alleging plan sponsors of imprudence relative to their target date funds. These cases have generally alleged one or more of a couple different potential allegations. One being unreasonable fees, alleging that the funds offered in the plan had expenses that were inappropriate relative to other target date funds available to the plan. Or that performance was unreasonable, alleging that funds underperformed, often significantly so, relative to funds that could have been offered. Some of these litigation cases have also included allegations related to proprietary funds, where a plan sponsor offered their own investment options in the case of investment managers, or where plan sponsors offered proprietary products of their advisor, potentially without conducting appropriate due diligence in offering those funds. An example of a recent target date fund litigation involved Walgreens. They're facing a fiduciary breach lawsuit relative to their target date funds. In the allegation, the participants have claimed that Walgreens breached its fiduciary responsibilities to participants as the funds underperformed, allegedly underperforming 70 to 90% of other target date funds available in the universe. Fiduciaries are responsible for appropriately selecting investment options and then monitoring them on an ongoing basis to ensure that the investments remain prudent and that the fees are reasonable. Often plan sponsors feel that maybe they should consider offering the cheapest target date funds they can find, which would usually be an index-based target date fund series. In going through that process, it's really important to remember that fiduciaries are held responsible for ensuring that fees are reasonable. And courts have gone so far as to suggest that it would be unreasonable to select funds only based on fees. We think this is especially important for target date funds, where target date funds really can't be fully index-based investment options. Managers are always making active decisions about what asset classes to include and how to allocate between those asset classes, even if the underlying investments are all index-based to drive down fees. So important for target date funds especially, but of course all other asset classes as well, to consider not just fees, but also the investment strategy and performance when selecting the options. So what's important to know about target date funds? First, it's important to understand how target date funds work, understanding how the funds de-risk over time, the meanings of the different funds in the series, and how they relate to the overall investment strategy. Second, it's important to be able to articulate some of the basic foundations of your plan's target date fund series. What is their investment strategy? How does that strategy compare to peers? At a high level, is it more aggressive, more conservative, or about average versus other target date fund series? And then how is the manager implementing that strategy? What types of funds are they using to populate the asset classes? Are those actively managed or passively managed? And how each of those exposures might change as participants age. And then lastly, it's important to understand how you're evaluating the performance and success of your target date fund series. What benchmark are you using? How does the series compare to that benchmark? How are you evaluating peer relative performance? We evaluate performance versus Morningstar categories, and there's about 65 unique funds in the target date fund peer group. So how does your series compare to those funds, and what does that mean for the type of performance that you should expect both near term and longer term? Well, if we think about where markets have come from in the past 3, 5, even 10 years, we've had really high equity returns. So that means more conservative series with less equity exposure than peers, generally have underperformed over these time periods. That makes them potentially a target for fiduciary breach litigation and alleging that they've persistently underperformed peers. But if we see changes in market conditions, if we start to see more volatility and more negative returns in stocks, we could see more significant underperformance from more aggressive series. And then that may make some of those series a target for fiduciary breach litigation, alleging that committee members and fiduciaries just didn't understand some of the inherent risks. The answer to that question is yes and no. The answer is no from the perspective that fiduciaries have substantively equal responsibility to select and monitor each fund offered in the plan. All of the investment options should be prudent investment options with reasonable fees. But target date funds may be a little bit more of a focus for fiduciary breach litigation for a couple reasons. First, they do tend to be the largest component of plan assets. So where there's more assets, there are more potential gains from a successful claim. But also, target date funds being used as the plan's default investment do take on a little bit of a special fiduciary role, given that the committee in selecting the default investment is selecting the investments on behalf of participants who don't make their own elections. So while it's important to have a process to monitor all investment options, for those reasons, we do have a little bit of an enhanced process associated with target date funds. So we recognize that our clients all have day jobs, that no one is a full-time retirement plan fiduciary here. And while we meet regularly to review performance and execute the process, sometimes that gets lost in the shuffle. So if you'd like to recap the process to select and monitor target date funds or review your series in particular, please let us know. And if you're not a client, would like our perspectives, we'd love to discuss with you your current process and our thoughts on your current target date fund series.